Hey guys, Mike here. So today we're going to talk about the warning that Cathie would put out late Friday to investors and the Fed, about what she sees coming down the road here. And, I'm going to use a phrase I hadn't used when it comes to Cathie Wood in a long time. And that is, I totally agree with her on the point she was making on the economy, basically what's on the horizon. Because she's seen this movie before. She started off as an economist. And so, she's very well versed in that. She understands what causes recessions and things like that, what causes bull markets, what causes bear markets. And so, if you have any animosity towards her because you bought dark funds at the all-time high or the stocks in them at the all-time high, and just set them to the side for just 5 to 10 minutes and actually listen to what she has to say. Because she makes sense. And when she puts the words out there, I'm going to put the data as she's speaking so you can actually see it to understand it's not just made up. It's right there, kind of in your face, saying, here I am. And so, that's what we're going to go over today, because it's good to get a fundamentalist perspective on this stuff and what they see. But it's not just her words, it's her actions and what Ark is doing with the portfolio. If you have not noticed over the last at least 3 to 5 months, they made some major moves. And so, you kind of see, I think they see the writing on the wall, at least for the next, 12 to 16 months, somewhere in that time range, of what's going to actually take place. And so, if you get anything out of this, hit that like, subscribe button. I really appreciate it. If you do like, stock market news briefings every day, private videos, you can see this right here. This is what I send out every morning, Monday through Friday, to the members. You can use the YouTube membership. If you like to do everything on Patreon, there's a link down right there in the description. You can use that as well. If you like that kind of stuff, everybody seems to like it and everything. So I scour the web, trying to find everything you need to know about not just the U.S., but the global markets, certain individual stocks, that kind of stuff. So just hit the link down below if you're interested in that. And so let's go ahead and get into it. And first, let Cathie would tell you exactly what she has done with the overall portfolio at Ark. And this, to me, lets you know exactly what she thinks coming.
We have concentrated our portfolio towards our highest portfolios towards our highest conviction names. So we've gone in some portfolios from the mid to high 50s down to 35 names. Now, most portfolio teams would not do that. In fact, what they would do during a risk-off period is diversify to get closer to their benchmarks, to hug their benchmarks, the benchmarks against which they're measured. In so doing, because our stocks tend not to be in the broad-based benchmarks, they are selling our stocks, and we are waiting for them to do so.
And so, of course, these actions are big. She is consolidating down that portfolio into those high conviction names because truth is she doesn't have the wiggle room like the other funds have to actually diversify. Like, she can't do like sector rotation like a lot of them are doing and going out and buying utility stocks or oil stocks, stuff like that. And so that's kind of what they're left to do. But it also lets me know what, in a way, is that signal she sees what's coming down the road. And so, that leads us into, what are the things she sees that a recession is definitely on the horizon for sure if the Fed continues down the path of raising rates and rolling off the balance sheet.
As you may know, we have been flagging that the bond market itself is flagging warning signs to the Fed. And so we'd be surprised if they go the full 50, especially because the bond market is sending stronger signals today than it has for some time. The yield curve has inverted. The 10-year Treasury bond yield is below the 2-year Treasury bond yield. And it's been, and when we get to the bond section, I'll talk more about the yield curve. But that is a sign to the Fed that either growth is going to disappoint or inflation is going to disappoint, or both during the next few months to a year. We've been amused over the last, I would say it's maybe 2 months, that once the 2s to 10s started to invert, there was a shift by people who just wanted to be bullish on activity and growth and value stocks, a shift to 3-month versus 10-year. Well, we've studied that, and the 2s to 10s, so that yield curve, is a leading indicator for the 3-month to 10-year Treasury yield curve. So I don't know why everyone took that jog at the same time. It was, as I said, amusing, but just know, at least from our point of view and from our research, the one that we place a higher priority on or place more weight on is the 2s to 10s. It's inverted. And in post-World War II experience, every time the yield curve has inverted within 12 months to 18 months, we have been in a recession.
And so understand what you're talking about here, guys. I have on here the 2 to 10 and then the 3-month to 10 year. And you can see right here, going across from left to right, so far the 10-year or 2 to 10 year has inverted first before the 3-month to 10 year, except when you come in, I believe it was 2019 over there, you can see the 3-month 10 year actually inverted just before the 2-year and 10-year did, as it looks to me. And this right here you can see is where obviously they're going in opposite directions, right? And so the 3 years taking off going up, and the 2-year, 10-year is actually inverting. The 2-year and 10-year is actually inverting. And if you go back and pause that and you look at that chart, there are multiple times where you can see where what's happening now is happening back then as well. As the 2-year, 10-year was going down to invert, the 3-month, 10-year was going up quite drastically, and all of a sudden it did an about face and just shot back down and inverted. So it moves very quickly. And so what we're seeing now is not unusual at all. And again, just go back and look at the chart, freeze it. And so you can see that yourself. You know, another one is what just came out of the Michigan report, right?
If the unemployment report was that good, why is the consumer in such a funk? If you look at the University of Michigan Consumer Sentiment Survey, you see some quite a bit of drama. So the peak for the University of Michigan's Consumer Sentiment Index was in February of 20, right before COVID. That was at 101. In April of 20, it dropped to 72. So that was a swift decline. By April of 21, it was back to 88. And today, it's down to 59. The lowest point ever, I think, in this index was 55 during the 08-09 crisis. We're almost there. So that period of time when people were losing their jobs and losing their homes and losing their autos and suffering mightily, that's how the consumer's feeling again. And of course, the reason is the hit to purchasing power that inflation represents, not just represents, is. And so we're very focused on retail sales. We're seeing a lot of retailers saying sales are starting to disappoint. They were up in February, the last metric we have right now, 0.3%. But inflation in February was up 0.8%, which means in real terms, consumption was down 0.5%. So that's down 6% at an annual rate. That is a huge hit to consumption. And if you look at the average since October, it's been pretty flat. The average real consumption has been flat.
And to me, this is simple. Why the consumer sentiment down? I've been talking about this for weeks because everything is so expensive. We just sat down and did our budget, and we, if you look at do an Excel spreadsheet and you're tracking about a month, you can literally see like, wow, we were paying in January $40 to fill up our cars with gas, right? Now both of us are paying $55 every time we fill up, okay? We're looking at our grocery bill, about the same thing every single week, and we're watching the increase, right? Month over month over month, right? That's just happening. And if you're spending more on that, you're putting in less away for retirement, you're spending less on vacations and going out to restaurants, and all this stuff is happening. I know we've cut it out a lot. We went to a cash budget as far as going out to restaurants and entertainment. Just to kind of lock it in to see exactly what we were spending. And it's helped us save a lot of money, but we're not spending as much as we were, right, on that stuff, because I just felt we were being ripped off. I mean, that's just the way I feel about it. You know, I mean, you could tell me the tuna I bought for 12 years went from $4. Now it's up. It went up again. It's up to $9.50. So I had to switch to a different brand, which isn't really as good, but it only cost me $4. You know, and it's the same amount of tuna I'm getting, right? I mean, that's happening all over, and it's going to continue to happen. Wait till this next CPI data comes out for March. My God, I can only imagine what that's going to be. And so, you know, that's a pretty obvious one why you see sentiment continue to go down, which is never a good thing. And so, obviously, when you start to see inflation come down, I almost guarantee you see sentiment start to rise again. How about that, whenever that may be? And so another one, and I've been hearing about this a lot, but I don't know a ton about it, is the spreads everybody keeps talking about as a warning.
The other thing that's a bit of a warning here are spreads are opening up. And what that means is corporate yields relative to treasury yields are starting to move up. And that's another indicator that bond investors are worried about the fundamentals of corporations, which of course are impacted importantly by the economy.
And like I said, I've heard and read about this a lot lately going on, and so I can only imagine that's why you're seeing a lot of negative earnings revisions actually being put out by analysts trying to lower expectations. And so to me, that's not a good sign, but it don't mean it's going to stop the market, because, you know, what are you looking for? If they beat expectations, the stock should go up, right? It depends on their forecast. One of the companies, I forgot the name, which put out, you know, beat earnings. Their forecast was terrible for the rest of the year, and the stock dropped 20% in less than minutes. And so there is, for her, a saving grace to say the bull rally or the bull market can continue if this happens.
Now, the other thing that's interesting about the bond market is if you look at the 2-year bond yield, it has already priced in the expectation that the Fed is going to move another 3 to 4 or 5 times, depending on how many 50 basis point moves are incorporated. And so this should be in the market. And if the bond market is successful in changing the Fed's mind, then we will have a very bullish environment. And I do believe that is what's going to happen. I don't know when, but I do believe that's what's going to happen.
And this is kind of one thing people are banking on, is that the actual work that needs to be done by the Fed is lessened as far as raising interest rates and moving as fast, because the market's already doing a lot of the work for them. It's kind of like in the real estate market, how you see the Fed funds rate only went up 0.25%, which is nothing, right? But now all of a sudden you got mortgage rates hitting over 5% now. Right, what's that going to do? It's going to tamper down demand, which is one major problem we have, is a lot of demand and don't have a whole lot of inventory, right? And so if they tamper down demand, the demand comes down, and we continue to build houses now, but they're vacant because nobody's buying them. All of a sudden inventory comes up, demand comes down some, you get this, you know, equilibrium to it or whatever. And so that could stop the prices from just soaring out of control like they are right now in certain areas. And so that's just one example. But, you know, that's something they're hoping you start to see in a lot of different areas. So it kind of signals to the Fed, oh, we don't have to do as much. The market's kind of already doing it for us, right? And so that's something she's banking on, something I've heard a lot of people talk about. And that's just unpredictable. I mean, you just don't know, because a lot of these Fed folks kind of feel like they're already so far behind, right? And they don't want to go down in history, as she even said, as their legacy being they're the ones that allowed the inflation to take hold of the economy and be 6 to 10% like for the next 3 years or something, which would be disastrous. And so maybe they were underreacting before, and maybe now they're overreacting. And so we'll see how it goes. Coming up, I think their next meeting is in May. So we'll see how that goes. I mean, but, you know, this is stuff, I like the data she was presenting. It makes sense. Obviously, things don't look well as far as there's going to be a recession. And I tell people, forget about calling it a recession, just call it a stock market crash, because that's what always happens there. You see on the charts. And so, you know, we'll see if all this pans out right. It really, a lot of it just depends on the Fed and what they do, and that's really we're at the mercy of right now, and what the economy overall starts to do and stuff. So anyway, hope you got something out of it. Hit the like and subscribe button if you did. I really appreciate it. Again, if you want to sign up, get daily news briefings, private videos, hit one of the links down below. We appreciate that, and I'll see you guys later.